Inflation is reaching multi-decade highs and still rising. Central banks are quickly increasing interest rates to fight inflation. The tragic war in Ukraine shows no signs of ending anytime soon, and China's zero-COVID obsession is continuing to damage global supply chains. And so it comes as no surprise that we've reached extreme fear levels and that broad indices are in bear market territory, with the S&P down 25% year to date, the Dow Jones Industrial Average down 20%, and the NASDAQ Composite Index down almost 32%. And as the stock market continues to be rather volatile to the downside, more and more investors are looking for so-called safe places where they can hide, meaning they are looking for investments that won't perform as poorly as other assets during the current crazy market environment. So, are there any safe places to hide at the moment? And what does all of this have to do with a concept called TINA that investors should be familiar with? Well, this is what I will discuss in this video. And so without further ado, let's get started. Alright, so as we are currently witnessing a ton of macroeconomic challenges, where can investors find shelter? Well, I would argue that stashing cash under your mattress is obviously not a great idea, considering the high inflation rate of around 9% that we are seeing right now. In the intro of this video, I shared the performance of broad market indices, and they have obviously not been a good hiding place this year. What about bonds? Well, 10-year US treasuries are offering a yield of almost 4% now. But then again, that's a negative real return if high inflation persists, and 4% is probably not enough for most people to reach their financial goals. What about real estate? Well, home prices have come under pressure due to higher interest rates, and as 30-year fixed mortgage rates have jumped by the most since 1987 and rose above 7%. Speaking of mortgages, I came across a truly crazy fact about mortgages on Twitter the other day. If you secured a 30-year fixed mortgage on a $600,000 home at a 2.6% interest rate in 2021, you have the same monthly mortgage payment as someone that just bought a $360,000 home at today's 7% mortgage rate. And so it should come as no surprise that, according to Charlie Bilello, US home prices fell in July for the first time since 2011, ending a streak of 126 consecutive monthly increases. So what about particular stocks and industries? Can we find any hiding places here? Well, I would argue that earlier this year, a place to hide for many fund managers were consumer staple stocks. Consumer staples sell basic goods that people buy to support their everyday lives, like food, beverages, and personal hygiene products. And generally speaking, these types of products are typically less sensitive to economic cycles. So again, early in the year and also last year, when especially fast-growing stocks, so-called tech and growth stocks, were coming under pressure and performing very poorly, as their high valuation multiples that were reached during the COVID lockdowns declined significantly, and as so-called COVID beneficiaries were lapping their very strong COVID quarters. Well, consumer staples stock prices held up quite nicely. The multiples they were trading at were rather stable, and the stocks as a group outperformed other types of stocks. Examples would be the Coca-Cola company or Pepsi, Nestle, L'Oreal, Procter & Gamble or Costco. But the graphs also show that now as the June lows are being retested, consumer staple stocks also started to perform more poorly in the second half of the year. And it's also worth highlighting that these stocks may not necessarily be trading at prices that are attractive relative to their intrinsic value, because often these businesses are only growing very slowly. The Coca-Cola company, for example, basically generated no revenue growth over the last 10 years. And thus, enterprise value to operating income multiples in the mid-20s can hardly be justified. Especially if you compare the stock to other businesses that may see short-term headwinds but have a much larger growth runway ahead of them and are now trading at multiples that are lower than the multiple the Coca-Cola company is trading at. Another area that may have been considered a safe place by many fund managers are energy stocks, which have outperformed broad market indices in 2022. But over a long enough time frame, commodity businesses like energy businesses will typically perform rather poorly as they achieve below average returns on their investments and have little to no pricing power. I highly suggest you pause the video here to digest these two beautiful graphs that Terry Smith, the founder of Fundsmith, shared in his 2021 letter to investors. Now, we could continue this list and discuss other investment areas such as emerging market stocks, private equity, or alternative asset classes such as cryptocurrencies or NFTs. But there's one major flaw in the approach that I have used so far for all of the observations that I have shared. Well, you might have noticed that everything that I have highlighted so far was characterized by a rather short-term view on the performance of certain assets. How did consumer staple stocks perform in the first half of 2022? How did energy sectors perform over the last few months? How did other asset classes like bonds or real estate perform recently? And apparently in a bear market, nothing is totally safe. But that's a very myopic approach that is overly focused on assets, prices and macro developments. And if you've been following me for a while, you will know that I'm a big proponent of having a fundamental and most importantly, a long-term view on investment opportunities. And once you change your perspective and adopt this long-term mindset, the investing world presents opportunities to generate wealth that is unavailable to myopic investors. And a good way to internalize this mindset is to understand the TINA concept. So what is TINA? Well, TINA is an acronym for there is no alternative. And personally, I believe that if you take a long-term, multi-decade view, there is no alternative to stocks, as historically, US stocks have been the best performing asset class, outperforming all of the other asset classes that I have mentioned in this video so far. Sure, stocks may appear risky in the short term because of their volatile nature. But if you take a longer term view, it's actually risky not to bet on stocks. And this idea is supported by this chart here by Charlie Bilello, which he shared on Twitter and to which he added the following comment: why you need to invest in one chart. And as this graph here illustrates, the longer your investment horizon, the less risky it is to invest in stocks, the less likely you are to lose money in stocks. Let me just share what Terry Smith wrote in his most recent 2022 semi-annual letter to investors about the TINA concept. He wrote, in inflationary periods, TINA refers to the concept that equities will be the least performing sector in such conditions because of the ability of at least some companies to continue to grow revenues in real terms and generate real returns on capital above the rate of inflation. Bonds with fixed interest coupons are certainly not the place to be in these conditions. Real estate may provide some safety, but it is a notoriously local market with poor liquidity and high frictional trading costs. Commodities have had a day in the sun at the start of this inflationary cycle, and this may continue or not, but there is no inherent return on commodities, no interest coupon, no dividends or profits reinvested. Investing them is pure greater fool theory. You can only make money by selling them to someone willing to pay more than you did. All of which may point to the fact that there is no alternative to equities, even though they have performed poorly so far this year. Terry Smith then continues to discuss whether cash may be an alternative for investors. Not as a long-term investment, but rather as an asset that can give you the dry power needed to pick up bargains when stocks are down significantly. However, Smith thinks that this presupposes that you can correctly time the market. He writes, however, even if you accept that it may be tempting to sell equities and to go into cash, as this may enable you to avoid further falls in the equity market, timing is of the essence in doing this. And if you haven't done it already, I think we can safely say you missed the top. Getting the other side of the trade roughly right will almost certainly mean buying back into equities when economic conditions are at their most bleak. This is a skill which few, if any, possess. Meanwhile, time spent in cash whilst waiting is hardly a good bolt hole from inflation. So what's the takeaway here? Well, Chris Meyer recently published an amazing blog titled a safe place to hide. And he opened his blog post by quoting what Robert Curry wrote in his famous piece, The Coffee Can Portfolio. As a money manager, I have frequently looked at an investment decision that I have felt a high probability of success on a 3-year horizon, but about which I had many doubts on a 6-month time horizon. And I think this quote nicely summarizes the issue I have with the idea of finding a quote-unquote safe place to hide. And just like me, Meyer himself is known to be a long-term investor that is focused on the best businesses in the world. And so it comes as no surprise that he later writes in his blog that, quote, "If your horizon stretches 10 years or more, then owning a good business is one of the safest places to be. Even better, own a portfolio of such businesses. I have no idea what the stock prices of my favorite ideas will do over the next 5 months. Chance would play a huge role in the outcome. And the odds are decent, they could actually be worth less. But over the next 5 years, I'm more confident they will be worth a lot more. What makes investing hard is that things don't unfold in an even or predictable manner. There are some great runs, there are nasty drawdowns, and there are extended periods where you seem to go nowhere. Each presents lots of opportunities for investors to make costly mistakes. Now, if you want to become a smarter investor, you absolutely need to continuously improve. And to do that, I suggest you check out the following video in which I share 5 lessons that I have learned from reading 99 investing books. Take care.